This is Dwayne Malone, and welcome to the ECAM update as of the market close on July 23rd, 2010. I want to start out by tonight's review by taking a look at the longer-term sort of 40,000-foot view of the charts and moving down towards the shorter-term view as we go along. I'm starting out first of all with the 11-year monthly chart of the S&P 500 index. As many of you know that have been on the blog for some time, this is one of the two sort of longer-term charts I used to judge whether we are in a bull or a bear market. Essentially, this chart uses the monthly candlesticks and a 12-month simple moving average. And as you can see on the chart, if at the end of every monthly close we are above the 12-month moving average, we are with the trend. In this case, you can see here we were in a bull market because we were closing monthly above the 12-month simple moving average. And then in October of 2000, we actually closed for the first time below the 12-month simple moving average on a monthly closing basis. That moved me into towards cash. I stayed in cash for the entire time on the decline all the way down until, I guess it was about April of 2003, where we closed for the first time above the 12-month simple moving average. At that point, I followed the markets on the way up, and as you can see, intermonth, there was numerous times where the intermonth price would drop below the 12-month simple moving average. You can see numerous tails all the way along here, but at the end of every month, you can see that the candlesticks still closed above this blue line. So we continue to be in a bull market. And as of basically December of 2007, was where we closed for the first time below the 12-month simple moving average. At that point, I made an annotation on the blog indicating that this was a very bearish indication, that I was moving to cash. And as you can see, we followed all the way down, tried to challenge here once at the simple moving average, but did not close above it, and then continued down all the way down towards the bottom. We actually got a bullish sign back in July of 2009, once again crossing above the 12-month average, and we've been in a sort of a bull market ever since. Now, I want to point out that the reason why I turned bearish in the last month or so was because at the end of June, we closed the month of June, which is this red candlestick here, for the first time below the 12-month simple moving average since the last bull market indication. This, to me, is the first of two or three indicators that I use to indicate that we might have actually gone back into a new bearish market. So I've become very defensive, and we need to be very, very cautious at this point. The next chart I want to discuss is the weekly charts on the S&P 500 index, and in fact, I actually used two different charts. The first chart I'm going to talk about is a very simple indicator that I use, and that is a moving average crossover between the 13-week exponential moving average and the 34-week exponential moving average. As you can see in the chart, the 13-week is a blue line, the 34 is a red line. And these are very, very good bull-bear indicators I've found over the last, say, 10 to 15 years. You can see through the period, basically 1997, which is off the chart, up until sort of the last quarter of 2000, we were in a bull market. At that point, we crossed where the 13-week EMA crossed below the 34-week EMA. We entered a bear market, and that was one of the sell signals I used. We followed that all the way down once again until essentially the first quarter of 2003, at which point the 13 crossed above the 34, and we entered a bull market. Now you can see that, towards this entire bull market phase, there was points at which the 13 got very close to the 34, but didn't actually cross. It sort of, came down, touched, and then came down, touched, but it stayed above, and even here a nice touch. But it didn't really cross below the 34 until December of 2007. So that, in conjunction with the 12-month SMA crossing below its trend line, as I discussed previous, was the two indicators that I primarily used to say, okay, we've now entered a bear market. And once again, I follow this all the way down, and I was not inclined at all to be in the markets while these two indicators were indicating we were in a bear market. Now, in July, once again, of 2009, these two indicators crossed on the upside. So that put me back into a bullish market configuration, and I put that onto the blog site. Now, I want to note that as of today, which is Friday the 23rd of July close, we crossed at 1102.66. The 13-week EMA is at 1094. The 34-week EMA is at 1096. So we are now in a position where the 13 is below the 34. This actually occurred last week and is once again another sort of bearish indication that we have potentially entered a new bear market. I'm going to give this a little bit of room because there is some room for movement on this. So if in the next, say, week or two, the medium to long term sort of turns back up again, we could still be in a bull market. So unto itself, this is a warning signal, but it's not something we can actually hang our hat on and make it our primary trending market tool. The second weekly chart I use of the S&P 500 index is a sort of a similar chart, but I include a number of technical indicators on this chart. So it's not so much a moving average crossover chart as a technical indicator chart. There's a number of indicators on this I want to have a look at. We have the Bollinger Band, which is these two bands here that are basically constraining the price, and within that we have the dotted line. This dotted line is a 20-week moving average. Essentially, in the bigger picture, when price is above this dotted line, we are in a bull market configuration, and when price is below this line, we're in a potential bear market configuration. Along with that, I use a number of different indicators, the Relative Strength Index, the RSI, and I use strictly this as a 50% level. So when it's above 50, we are in a bull market, below 50, potentially in a bear market. With that, I also use the full stochastic, again, using the 50 level to differentiate between a sort of bull market condition and bear market. The MACD which is the mean average convergence divergence, and when those are in a bull market configuration, we have a positive crossover, and when it's bear market configuration, a negative crossover. With that, the ADX line, and the ADX uses the DI minus lines. These are these little red versus green lines. You can see when the red is above the green, very simple. It's like a stop sign. We are in a bear market. When green is above the red, we're in a bull market. And lastly is the force index. I like the force index because it not only uses price, but also uses volume. And in addition to the actual price levels, it's very important to know where the up volume is versus the down volume. So this is a good indicator as to whether we have volume supporting price or volume supporting a decline. And going back to our last indication, basically at the end of April, we crossed for the first time on a weekly closing basis below the 20 period moving average. In this case, it's the weekly average. The RSI confirmed by dropping below 50. The full stochastic confirmed by dropping below 50. The MACD reversed and crossed to the downside, and you can see this with the histogram dropping below 0. The ADX also confirmed with the red now above the green, and the force index switched to red. So this was a really, really good indication that we had actually entered a correcting phase, potentially towards a bearish phase. So these are the two indications that I use along on the weekly chart, along with the monthly chart I just talked about previous, to give me an indication that perhaps we are into a new bear market. This is part one of the update. Next, I will give you part two, where I talk about the daily and interdaily charts, and those are looking much more bullish in the very short term.